Welcome back, everybody, to We Are TPM with myself, Kyle Teixeira. Sitting next to me again is John Teixeira, and this week we have a guest with us, Trever Kerr with Gateway Mortgage. Thanks for joining us, Trevor.
How are you guys?
Doing great. Appreciate having you in. This week we, as promised, are going to be talking about loan assumptions with Trever here to help give us the details on that and give us a little market update on the mortgage market, I should say. And the real estate market, I guess, at the same time. So
Yep.
If you guys have any questions about any of this, want to connect with us or connect with Trever, give us a call, 817-818-9039. Shoot us an email at showmethemoney@wearetpm.com. Let's assume we're talking about loan assumptions, right?
The pun. The pun starts. I love it.
Starts.
Hey, Trevor, the reason why we wanted to talk, we needed to get a market update from you, but it's, the market is ripe again for certain things that we used to talk about a lot. And, we did a podcast last week on subject twos, which really hasn't been a thing for quite some time until recently. Assumptions kind of falls in that category of
creative financing,
things that are coming back.
It is something
because of the market.
It is something that we definitely need to be keeping an eye on, and that we're seeing a lot more. Assumptions haven't been around for about 18, 19 years now, okay, due to where market rates and stuff were at that point in time. But right now, assumptions is definitely something that people need to consider. It doesn't help the lender at all doing these assumptions, but it is a smart thing for your clients to be aware of and know options on, okay? A lot of people don't really know how an assumption works, but an assumption basically comes down to whatever that current seller has as far as a interest rate on a mortgage and stuff, their loan may be assumable. And I say maybe. There's a lot of loans out there that don't allow assumptions, okay? But for the most part, all government loans do allow assumptions.
That's
okay,
the general rule of thumb.
General
you gave
rules.
us.
They're called qualifying assumptions.
Qualifying
right?
assumptions.
Yep.
And so at that point in time, the seller, we need to get in contact with the seller's lender, find out, is their loan assumable or not? And if it is assumable, it is definitely something that they need to probably look into, because who knows, they might have that beautiful 2%, high 2% interest rate, or 3 or 4 or something that's a lot better than what the current market rates are.
Yeah. A lot of those rates can look good right now.
Oh, yes.
Yeah.
Well, and thinking practically about it, as we come out of a seller's market and into a more neutral market, and maybe, who knows, we may even slide into a little bit of a buyer's market here. If that happens, then we are going to be in a position where people are actually going to be looking for these opportunities, because if I'm a seller and I've got 2 buyers in my neighborhood for homes, but I've got 6 homes on the market, that's a pretty competitive market. I need to find a way to make sure I'm one of the 2 that's chosen. And one of the ways you can do that is knowing whether you've got an assumable loan or not, and actually marketing that, right?
Most definitely. That's going to help one seller stand out from another seller a lot at that point in time, as they can market their home as, hey, I have a 3.25% assumable loan, you know. You have 2 houses sitting next door to each other. One of them has a 3.25% assumable loan, and the other one doesn't have that, and they're having to go out and get their current, 6.875% interest rate. Obviously, a buyer is going to look at that one. Oh yeah, I want that house, even though that one doesn't have the fancy tile that I wanted like the other house, but that one has a 3.25 rate, that I can assume.
So let's talk about how that would work, Trevor. Let's say I have that scenario. I've got one at 3.25. I want to sell my house for, let's say, $500,000, and I have a $350,000 note that you can assume. What does that look like at closing? What's that look like?
So a couple different things. Obviously they have to contact that lender, go through their credit qualifications and stuff with that current mortgage servicer. Okay, you can't go do a new loan and assume that loan with a different lender, but they go to that current mortgage servicer, once they know it's an assumable loan, do their credit qualifying and stuff. They can only assume that exact loan. So like John was saying, they owe $350 on it. The seller's selling, for $500. You're going to have only 2 kind of options. They're either going to have to come out $150K cash, okay, to pay that seller the remaining balance off, okay, from their sales price, and then they assume that loan. Or there are some secondary loan products where you can go get a second loan, okay, pending on LTVs and stuff. You're not going to be able to do 100% financing, okay, so you're still going to have a down payment, but you might be able to go pick up, $100,000 on a second loan.
Because most people buying that house are going to have to pay. They're going to be paying 20-25% down payment anyways.
Sure.
So you're already planning to bring a significant amount of money,
$100,000 or something. So in this scenario, you'd have to bring 150, but that's a lot better than.
Well, and it could work well for investors too, because you have, they could be wanting to buy this house all cash and now have the option of, half this can be financed at a good rate, where they were only not considering financing because, the rates suck right now.
Yeah.
So spending too much on their money.
No, it's just something that the general public needs to know about. You haven't had a lot of information out there, recently or over the last, 18, 19 years, because we haven't seen them. There was no really purpose for them because interest rates were so low.
Well, and it can be a piece of the transaction that's actually valuable to the seller.
Yes,
because
very valuable to the seller.
Yeah, I can offer you financing you can get nowhere else. Depending on the portion of it, right?
Sure.
But, you might even get more out of your sales price for that.
And be very valuable for the buyer too,
yeah.
Potentially.
And let's think about it from an investment standpoint. Investors are always looking at their bottom line. They're looking at their cash flow. They're looking at their ROI, all those things. This directly affects their monthly cash flow enormously.
Sure.
And so if I'm an investor and I'm looking to let's say I'm looking to buy another SFR, single family residence, and I've got, X amount of dollars to do that, and I have an opportunity to buy one with a low interest rate and assume that thing and then just pay cash for the rest of it or whatever it is, I'm going to do that all day because my cash flow on that house versus me getting a traditional loan on it is going to be enormously different.
Oh, yeah.
And tying it into what the subject 2 we talked about, not that we want to bring all that back up, but some of the cons of subject 2 are the risk portions as far as not actually having the loan in your name, but having the deed in your name and all that. This kind of gets rid of that. It structures the deal very similar, but gets rid of that risk.
All those, Sure. There's
none
of those
caveats, or the due on sale clause, all that stuff. So that we talked about.
And we tied that in because we talked last week a lot about how the similarities between assumables and subject twos and what the differences were and so forth. And so thanks for tying all that, wrapping that up for us, Trevor.
No problem.
And going through that with us. You want to...
Well, follow-up question. Have you done any loan assumptions lately?
Ooh, good question.
No. The loan assumptions and stuff, me being a lender and stuff, that happens all on the secondary servicing side. Yeah. So I don't have really anything to do with any of the assumptions. But I know our servicing department has already started seeing quite a few assumptions.
So the loans you've originated quite possibly have been assumed.
Most
you just wouldn't know it.
Sure.
Yeah.
Let's specify a little bit more the general rule of thumb there of government loans. Like, so you got the 3 most people know are FHA, conventional, VA, all that stuff. So
USDA loans and stuff USDA loans are assumable loans, VA loans are assumable loans, FHA loans are assumable loans. Most conventional loan products are not assumable.
That's
so Fannie Mae, Freddie Mac don't allow assumables.
That's correct.
Okay.
What about conventionals through Gateway Mortgage?
Those are still Fannie Mae and Freddie Mac.
Yeah. So. Well, good question. So, I mean, this is a simple topic because it's very straightforward as far as the what and the how. You just got to do it.
The one thing that I would encourage, if you are selling your home, I would look into before you, put your house on the market. Definitely, see if your loan is assumable because, like you said, that's going to make a seller stand out, from the other sellers out there.
Mm-hmm. Could you imagine having one of these Texas Vet sellers that got in when Texas Vet was even better than VA and they were getting them for like 2% or something? Imagine running across one of those.
Yeah.
And
you might just buy that house just because of that.
Yeah.
And then on the buyer side, I mean, there's scenarios where it could help you qualify for a house you otherwise wouldn't qualify for. Because in that same example of $500,000, if you have the $150 to put up, but you
Good
don't
point.
qualify for that 350 loan at 6.7. You may qualify for it at the 3 that you're assuming
point.
it at.
Oh, yeah.
So
Most
because the monthly
definitely.
payment's significantly different. So,
Sure.
Back to buying more house, right?
yeah.
So if we put that to bed, where are interest rates going? What's the market looking like, Trevor?
Interest rates and stuff right now, depending on loan program and credit scores and stuff, interest rates are in the high 6s, low 7s, depending on what kind of loan product and credit scores and qualifications you have, So they were earlier this year, they were anticipating rates coming down towards the end of this year and getting closer, to the low 6s and stuff. That has been adjusted a little bit. I don't think we're going to see that this year. Okay. I think rates are going to stay pretty consistent where they're at right now. Okay. And they are still anticipating, which next year's an election year. It's not a matter if it's going to happen. Election years, rates always come down. They always want to look a little bit better during election years.
Well, and really, we haven't had any major economic changes, and really until that happens, we're not going to see much movement. Is what's expected. So.
Not much movement in the interest rates and stuff over the rest of this year. Now, next year, they are anticipating rates coming down, down in the mid 5s and stuff. So something to look forward to. But the one thing that I encourage people to kind of, have some more knowledge on. A lot of people are sitting there and might be saying, well, okay, then I'm going to wait until next year to buy this house. Okay. Or look for my house before I do that. Okay. I strongly encourage people to start thinking about what they're doing on that, because I would not recommend doing that. Okay. Buy your house right now. Okay. Even though you might be paying $200 more a month. Okay. When you add that up, $200 more a month. Okay. Over the next year or so, sure, you're going to pay an extra $2,500 more in interest at that point in time. That doesn't make people happy, on there, but $2,500 over the next year or so, not a big deal, even if it takes 2 years. Okay. So now at
least you're building wealth.
You're $5,000. You're building wealth in that house. And if you wait until rates come down next year in the mid 5s, this market's going to change again, and everyone's going to flood back in the market, and those prices are going to go way up. So now all of a sudden you're paying 30, 40, 50 grand more for that house when you could have had that same house and paid an extra 4 to 5 grand in interest. So why not buy this house right now? Refinance. You can always refinance.
And if the experts
always
are telling you
refinance.
that, and how far back do we have to go to show that mindset was right? I need to wait till next year. You have to go really far back, probably to 07, 06 to even make that.
Further back than that.
I
But
think you have
yes,
to go into the 90s.
Yeah.
it happens all the time. I mean, if you look over history and stuff, it's smarter to buy your house right now, pay that extra 4 or 5 grand, 2 to 5 grand in interest, than it is to wait until this market changes again and interest rates come down. Because as soon as that does, this market's going to be flooded again, and prices are going. Yes, prices are going to go way up, and now all of a sudden you're going to pay 30, 50 grand more for that house when you could have paid 4 or 5 grand more in interest.
And we saw this all in 2021. I mean, people didn't just have to wait a year. Now they're waiting through this market because they got priced out. They wanted to wait for prices to stop going up and didn't realize that interest rates had a way bigger impact than the price of houses on affordability. So a year later, they can't afford those same houses, which is really the problem. And like you're saying, it's just going to the balance between prices going up and interest rates going down. You're not going to find a happy medium, but you can just purchase the house and plant the seed, like we always say.
Yep.
Start paying it down. So
I don't know why I'm here, y'all.
You look like you had something to say.
I have no idea why I'm here. Every time I have something to say, y'all just steal my thunder and you take it, and we're all on, which is a testament to the fact that all three of us are on the same page. We all understand this wealth building thing exactly the same way, and that's what we try to do, Kyle. We try to come here, we try to tout that and send the same message, right? Every single week, no matter what. This is about building wealth with real estate. It works no matter what you're doing, how you're doing it. Don't get lost in the details. Get over the interest rates. The interest rates are still below historical average. They're just way above memorable average is what it comes down to. But get over it. Just if you want to be a real estate investor, be a real estate investor and do it and get in. If you have an opportunity like the assumable that we talked about, then take it. That's great. But to Trevor's point, don't get all wrapped up in the details, the monthly payment, the interest rate, all that stuff. All that stuff works itself out over time. And it's changeable too.
Very well said.
Yep.
I mean, see, you got your
I just-
thunder in there.
why
I
you're
just
here.
summarized everything that you guys said.
And that's why we've been talking a lot about creative financing, is because as the market changes, there's ways to still make it valuable, right? And it brings up to mind when we had Trevor here about almost a year ago exactly.
God, is that long ago? We need to have you here more
It
often.
was this time last year we were talking about
flies.
arms.
Yep.
And just for that
My
reason, I
arms?
want to bring up the question of, is that still the product you want to focus on?
No, arm rates right
about
now
legs?
and
Can we
stuff.
talk about legs?
Legs?
Legs.
Legs, I don't have any legs.
No?
For,
I think you used that one
Mortgages.
a year
Yeah.
ago. Yeah.
it's been a year.
Yeah.
They've forgotten about that.
Use
so
that again.
I'm sorry.
at this point
bring
in
us
time,
back to adjustable rate mortgages. Sorry.
the ARM product, the adjustable rate mortgages and stuff, it's not something that I'm recommending and stuff for my clients right now, just because the way those are priced right now, the ARM rates and stuff are almost the exact same as a 30-year fixed. So
Yeah, and when we're
there's
topping,
no reason.
when we're likely topping out on rates, it doesn't
Yep,
make as much sense.
exactly.
Yeah, because
So should we geek out a little bit on the loan thing just for the people that understand it all?
Go ahead.
Yield spreads?
Yield spreads.
Yield spreads are kind of the reason why all that's happening, right?
Yep.
So I know that that's going to be difficult for the people that don't understand yield spreads, but for the people that do, that's kind of like how a mortgage company, like a back end payment. It's a way that mortgage company gets paid for setting up a loan on the back end from, what do we call
From
it? The
Fannie
lender.
Mae,
From
Freddie
the
Mac,
right.
from the lender and stuff.
Right.
So yes, the yield spread premium and stuff is really essentially how the lender makes money. Okay, and when rates were lower and stuff, the yield spread and stuff was much higher. Where you could, the difference
Explain that.
between
The reason why they were higher was because the lender knew that you would never refinance that
you're
loan.
Not, you're not going to refinance. This loan product, you're going to be in there until you sell it.
You're at
So
2.35, you ain't going anywhere.
yeah, at that point in time, they're looking at the average person is going to hold on to this loan for 8 to 10 years. Okay, so there's a lot more value, in that loan than where we're currently sitting at the market right now. The lender knows right now this loan's only going to be out there for about a year. Okay. So when they start looking at how much interest are you going to make over a year? Not very much.
Yeah.
Okay. And so that means not very much. So that means the lender's not going to be able to make any yield spread on it as well. So that's why rates are higher. Okay. Because they know these loans are going to be refinanced in the next year.
Well,
and
that's
they're
why-
originating less of them too.
Yep.
So they're
Yep.
calculating all that in.
Yeah, and to your point, that's why the adjustable rate mortgages was something you were pushing and selling because the yield spread was still good,
Yep.
right? And now it's not good, and that's why you're not selling it. It's not because the money's not going into your pocket. It's because what it translates into is a higher interest rate for the consumer. And so then it doesn't make sense. It doesn't make any
Most
sense. You
definitely.
might as well just do a fixed rate, and there's no advantage to it.
That's exactly correct.
Yeah.
I have a question that brings us back to assumable mortgages because the point I didn't hit.
Oh, we're going full
it
circle.
was the amortization schedule. So you get you
that's a
join
good
in
question.
wherever that's at.
The
Correct?
yes, you're taking over exactly where they left off. So at that point in time, if they still only have 12 years on the mortgage, you're assuming that exact mortgage, that exact amortization schedule. So you're walking in
great
with
question.
a 12-year mortgage essentially.
Yeah, so which means even though the whatever the loan amount is still the amount you were credited at closing, you are now you are paying more towards principal than interest.
Most definitely.
Yeah, because
obviously depending on how long this loan's been in effect.
yes, I more meant you're paying more towards principal than you would if you were on day one of a 30-year loan.
Most definitely a
Yeah.
drastic difference.
Yeah. So there was a big point that I didn't bring up in that. So do you have any more bombs for the market update to drop on us? No?
No, but I was sitting here thinking about how people don't, you and I have talked about this quite a bit. People, and Trevor, you and I have talked about it also. People don't appreciate the front loading of interest on loans nearly enough. To your point, I'm sitting there thinking, man, that would be beautiful if you can get rid of the first 4 or in that case, 16 years worth of interest? Like, oh my gosh, that'd be a dream scenario, right? Like even if the interest rate was 8%, it almost wouldn't matter at that point because you've already paid most of the interest up front. And so if you don't know what I'm talking about, if you're out there listening, wondering what the hell I'm talking about, when you pay for a mortgage or any loan that you get, the interest that you pay, most of the interest that you pay it's called front loaded because you pay more interest on your first payment, has tons of interest, very little principal. Your last payment has tons of principal, very little interest. And it kind of goes from one, gradually from one to the other.
And to help them understand, because that might confuse a lot of people of, well, why is it all front loaded and stuff? It's really not front loaded. It's just when they're figuring that interest out, it's based on the balance of your outstanding loan. So they recalculate that every single month. Mm-hmm. So at that point in time, like John's talking about, your last payment, of interest, you might only be paying $8 worth of interest on your very last payment on a mortgage. Okay. Because at that point in time, your balance is what? Couple, $1,000, $2,000 or whatever. You're paying very, very little interest. When you start off with that loan, you have your full balance. You're not paying a whole lot of
You're
principal.
Paying a percentage of it.
Yeah.
So, yeah. I mean, and that's not specific to mortgages. That's how loans are structured. When you have a fixed monthly payment, that is just how the math works on a fixed monthly payment. You're paying $900 a month, and when the balance is so low, your percentage of that is what goes towards principal.
Exactly.
Snorting into the microphone. Sorry. That's exactly the reason why, though. I have been, for me, a proponent, and I have disregarded cash flow probably more than most people do. And I've been a proponent of going to the 15, 20 year. I mean, my wife hates it. When we had to take advantage of some lower interest rates. I'm like, yeah, but I totally want to take advantage of these lower interest rates, but I've been paying on this darn house for 15 years. So let's do a 15-year note. And I realize that in the 15-year note, I still have the same issue, the same problem that you just described. But at least I feel better about the fact that I didn't just waste 15 years.
You get there a whole lot faster. Yeah. And, that the amount that you're paying towards principal is a lot higher on a 15-year starting off day one than, of course, on a 30-year.
If I pay...
The people would think it's a misconception that the interest paid on that loan in a 30-year versus a 15 is double, and it's not.
It's not double.
It's
but
more than double.
Depending on where interest rates are at that point.
Let's do the math on that. You want to do fun little thing? Because you're good at math. I know you can do this. Okay, so if I bought my house for $250,000 on a normal 30-year amortized note, let's say I'm at 6%. What's the estimated total interest I would pay over the life of the 30-year note if I had it for 30 years?
Interest rate wise, around that, you're going to pay, give or take, about $550 or so.
$550. So almost over twice what I paid for the home. So $550 is the number. Now, what if 15 years into that note, I stop and I refinance to another 30-year note and I do it again? Now I paid, how much of that $550 did I pay for that first 15 years?
That $550, you're probably paying about $375.
We're doing some guessing, but you're probably not too far off.
We're guessing about $375.
A good majority of it, I just paid. And now I'm about to start over and do it again, 30 years. Maybe I took some cash out. Now I have maybe I still have a $250,000 note because I took some cash out at 30 years, maybe even at a better interest rate. So now instead of $550, maybe it's only $500
or $450, somewhere in there.
Whatever.
But yeah, you're starting over
again. And if I do that again in another 15 years, now I paid $375. I paid another $300 in my second one, and I could just keep doing that. And these lenders are going, bring it.
Keep doing
that.
You're pretty old at that point in time, though.
Yeah,
I mean,
that's true. That's true. You can only do 15 years at a time so many times before you're dead, huh?
But it's worth considering that argument when you cash out refi it and bring that principal balance way back up too. So,
most definitely.
Because now the balance you're paying that interest on is higher.
It's just something that people don't consider because people are we talk about this, Kyle. Investors are so short-sighted on their cash flow and they forget all the things that you've talked about, Trevor, that your appreciation matters. And homeowners, consumers are the same way. They get so wrapped up in their monthly payment and what they can do with their monthly payment by refinancing, they disregard the entire conversation we just had about, their interest and how much interest they're paying over the course of their owning real estate. We've all done it. We've all done what we just described. Every single one of us in this room have probably done it. But, if you're conscious of it, at least you reduce the amount of waste, because that's what it is. It's waste. You're giving money away to save $20 or $100 a month. You're giving money away to lenders.
Well, it's all about education and stuff, and so I pride myself on educating my borrowers, on that, and that's partly what we're doing here right now.
Beautiful segue. What a beautiful segue, Trevor.
Educating people knowledge is power, right?
On that note, Trevor, I mean, Kyle, I think you should close this out after that. That was such a beautiful segue. I think that was a good.
Well, if you want some education by Trever Kerr with Gateway Mortgage, how do they get a hold of you?
You can call me anytime at 972-822-7408.
There you go. And if you want to give us a call, we're happy to give you his number, and 817-818-9039. Shoot us an email, showmethemoney@wearetpm.com. And appreciate you guys checking in. Thank you, Trevor, for coming in.
Thanks for coming, Trevor.
Thanks for having me.
We are out.
Late.